Hey everyone, hope you're doing well. Thanks for joining for October's market update. If you are joining on the podcast and that's where you're listening in, I will put the presentation in the show notes because we're going to be going through some charts today like normal. And so I just want you to be able to have that information in there so you're not, flying blind with the information that we're going over. So that will be in the show notes. And for those of you that are catching this on video, thanks for joining and listening in. The whole point of these is just to keep you informed. Just with my interpretation and what I'm looking at with what's happening in the market. So just to try to help you process that and digest everything that's going on. There's a lot going on in the world. So hopefully these help you just digest that information. The point of investing is just to always make informed decisions and not emotional decisions. So these are just to help keep you informed so you know what's going on and you can be aware of what's going on with your money. So yeah, let's get into everything we're going to cover today. So we'll always start with just who Selah is. Selah was founded in 2019 with the goal of bringing confidence and organization to people's financial life through education. That's stewardship and empowering wise decision making. Holistic wealth management and planning firm located in California, but serving clients nationwide. So I serve millennials, families in all different life stages, and retirees. Here's just what we're going to be going over today. Market update is what we're focusing on again today. There's just a lot to unpack with everything that's happening in the market. So we're not doing any behavioral finance to go along with it, but we always start with a quick look. That's just our chart that shows us what everything, where the market is, the different indexes, where they are for the year to date. And then we're going to do a bull market check-in. It's been 1 year since the bull market began in October of last year. So we're going to do a check-in and see where this bull market stands compared to previous bull markets, first year, 12 months. We're going to do a talk about geopolitical events on the market, how those impact the stock market and what we can maybe be expecting just with everything happening in the Israel-Hamas war. And we're going to talk about inflation again. Surprise, surprise. We've been talking about inflation nonstop for what feels like a couple years now. So we're going to talk about that again and just inflation losing its stickiness as of late. So maybe some good news there. So let's get into this quick look. This again is a chart just giving you what has happened in the market year to date. This is as of Friday of last week. So not anything happening today. This is recorded on Monday, October 23rd. Just FYI. So quick look, S&P 500, we are now at a year-to-date return of 11.45%. So we've given up a few percent in the S&P for the year since July, since we've hit a little bit more volatility since the end of July, as the high I think was right at the end of July 29th or something. So we're back down a little bit off those highs. NASDAQ also down off its highs of a year-to-date return of 24.87%. Looking here. And then the Dow Jones is pretty much flat on the year, just 1.67% year to date. So pretty much flat on the year there for the Dow Jones Industrial. I've been pointing out, and the reason I've been pointing this out in the S&P 500 index sector, the second chart here, is just where the winners have been so far this year. We've been keeping a close eye on that information technology and communication services. Those are also both have come down a little bit here. Information technology, 34.6%. Communication services has come back a little bit from where it's caught up. Basically, it's stayed a little stronger than the information technology currently right now. And then you see this just consumer discretionary has picked up a bit as well in the second half of this year. But those have been the top indexes. The top sectors so far in the S&P 500 index year to date. So that is again just to explain again. That's why you see that NASDAQ is outperforming the S&P. And well outperforming the Dow Jones Industrials just because that is very heavy tech. And so you see that information technology is what's pulling up this NASDAQ composite year to date as well. So let's talk about bull market check-in. Again, October 12th, 2023 marked the 1 year anniversary of the new bull market. So we hit our lows of this bear market hit its low in October of last year, on October 12th. So once we got 20% off that low, that confirmed a new bull market, and it has now since been a year since that low. So looking in and celebrating that 1 year anniversary of that low and this new bull market, and just seeing where we compare in the returns we've experienced in that first 12 months of this bull market compared to previous previous bull markets. S&P 500 had a gain of 21.6% in the first 12 months of the bull market, which is historically underwhelming, considering the average and median of the first 12 months of a bull market. Sorry, I'm confusing myself today. The first 12 months off, that first low, from the low off a bear market, confirming that new bull market, the first 12 months of a bull market, average and median has been 39.6% and 33.7% respectively. So we are well below that, so pretty underwhelming in the first 12 months. And actually, this is the second lowest 12-month gain off a bear market low since 1957. So nothing really too exciting. Nice to have those gains, 21.6% at that year mark of October 12th, but very underwhelming considering where previous bull markets have been. Now, maybe not underwhelming considering the amount of headwinds we've experienced this year with inflation and the Fed raising interest rates. So maybe considering the impact that those have had, that it hasn't been as underwhelming. It is underwhelming historically, but considering we got to that 21.6% with everything going on, maybe let's look at the bright side and think that's a win. That's a positive. So that's the first year of a bull market. What can we expect in the second year for second year bulls? Again, here's another chart, and you can see us here. This chart we're looking at here is listing every bull market from, again, 1957 to now, and ranking them lowest first year return to highest. So lowest was 1987. Here we are, second lowest of 21.6. 1987 is just 21.4. So pretty hand in hand there with the lowest one there. And then the highest first year return being COVID. So March 23rd of 2020 was the low during COVID. That was that bear market low. So that 12 months after that low produced 74.8% return. So very big year there. But average and median 12-month returns for the second year of the bull market. So we saw that was 39 to 33% for that first year. For the second year is 13 and 14%. Here we go. Average and median returns, about 13 and 14% respectively. Here is what 1 month has happened after that first year, 3 months after that first year, 6 months, and then 12 months, and then max drawdowns is listed here. So don't expect a linear path in the second 12 months. Always remember, every year in the market, there is volatility. So there is short-term volatility that does happen. Max drawdowns vary greatly in that second year bull market, from the greatest being, max drawdown of 33.9% in 2018 to only 6.2% in 1990. So with the average being 16.3% total. But so it's not like we get to the second year bull and everything just kind of keeps creeping up. There is going to be volatility. There's going to be drawbacks down again this year and this next 12 months. But if we can continue in a bull market, average return is about 13 or 14%, but an average drawback is about 16%. So there's going to be those drawbacks during this time. Now, if you look again at the 1987 here, first year return 21.4 compared to our 21.6, so very, very similar. They actually had a very strong, actually strongest on this chart, second 12-month return. So within 24 months, that second 12 months did 27.8%. So they had a much bigger second 12 months than that first 12 months of that bull market. Maybe we can get to that point as well. Maybe that shows us there's some room to run in this bull market. We got some room to make up some ground. Maybe, hopefully. I do think we're going to have to clear some of these other issues off the table to get to there. But that is a possibility. So maybe something to kind of consider again on the bright side, looking at the bright side of maybe what we can expect in the second 12-month period. So here I want to show you, this is just a chart. This next chart is showing the progression off those bear market lows in a 24-month period. So again, this orange chart here is us at 21.6% at that 12-month period. The average return for a 24-month period of a new bull market is about 57%. And we've only returned 21.6% so far. So in order to keep up with the average, we'd have to have a return this year in the second 12 months of about 35%. So that would be a lot. So there is plenty of room to run in this bull market, again, if we can clear off some of the things, the headwinds that we are facing. But that's obviously some big ground to make up. So, maybe we will still fall below that average, but that is an average 24-month return off a bear market low for a new bull market. And this is another reason, just as a side note, to point out to you again that this is another reminder that you need to stay invested, because those first couple years off those lows have really big returns. And that doesn't mean that everybody saw that was going to happen. There's always bad news, and there's always that contrarian opinion of like, okay, yeah, this could, go a certain way, but there's always going to be those, but what if, even throughout those years. And historically, that's happened those years as well. So if you could ignore the noise sometimes, and you can stay focused on historical trends of things that have happened and see where we fit in with those historical trends, it just helps you become a much wiser investor, because you're blocking out that noise. Yes, there's always headwinds. There's always something that's happening. But historically, what have we been able to do previously, and can we maybe do that again? And it's just a reason to stay in the market and not get out of the market, because this growth and this return happens when these markets turn around. It's not a few years later, once everything's all fine. That's too late. It's actually before you might know everything's all fine, we start to get these returns. Because again, there's those big drawbacks. We just saw that there's drawbacks in these years. So that means these markets previously are dealing with things as well. They're dealing with headwinds. They're dealing with possible recessions, inflation, other things that we're seeing now. They've dealt with it in those years too. They have the big drawdowns. They get it figured out, and the market moves on. So it's just another point, a reason to stay invested, because if you're trying to time this to get back in, you can miss up to 57% growth if you just miss out these 2 years. And these are 2 years that happen right after that low. So before the good news has come. So just that reminder, this kind of shows you the importance of just staying invested and sticking to your game plan. So next we want to get into just the impact of geopolitical events on the stock. So, okay, yes, great. New bull market. Here's what we've done first 12 months. What can we do the second 12 months? But we know there's a lot on the news of some really big things happening. So how does that affect this next this current bull market? Are we going to go backwards? And that's obviously a big question. There's a lot going on with Israel-Hamas war, and there's a lot of concern that that's going to put a halt to some of this recovery that we're hoping to finally start seeing, especially as we're just like, oh, can we just get a relief on the oil prices? Can we get past inflation? Now, what is this going to do to all of that, right? So we're going to look at what the impact of geopolitical events has had on stocks in the past. And as a side note, this is part of my job to look at these types of things and help break this down for you. This does not discount and sometimes it can feel cold just talking about these type of things with just looking at the numbers and how it's going to impact our money. And that's obviously not where my heart is. My heart is for those people, and just everything that's happening in the Middle East is tragic and horrible and very terrible to watch. And I know you all feel the same. And so it's balancing that and just seeing what's going on over there, and just can't even imagine having to live through that there. And it just feels like nice to just be able to talk about how it's going to impact our portfolio here. But that is, what my job is to do at this point in time is just helping you translate what is happening there and how it is impacting your portfolio here. So definitely praying for this whole situation, and would love to see it resolved and come to peace So we will obviously be waiting to see what happens there. But if you look at this chart here on this page, it is showing you about 24 or so events going back to World War II. And it breaks down, obviously, the event date here you're seeing. 1 day returns when that first event first happened, total drawdown during that time, how long it took to get to bottom, and how long it takes to get to for recovery to happen from that bottom. So total drawdown from this tragic event is obviously very unknown. We don't know because we don't know what's going to happen. It's going to depend on a few different things. So we won't know till after the fact. But based on prior geopolitical events, average drawdown, total drawdown is 4.7%. Average time to reach market bottom is 19%. And average recovery time is 42%. I'm sorry, 19 days and 42 days. So again, sorry if my brain's not working. So those are, average bottom takes about 19 days during these geopolitical events and about average 42 days recovery. So this is everything on here, again, till World War II. So you have this Pearl Harbor attack, which I know you can't see the full thing. Pearl Harbor attack. We see here U.S. terrorist attacks, 9/11. You had right away 5%. Now, just as a reminder, the market was actually not open for a couple weeks after the terrorist attack. So this was when the market reopened. What happened? You had a 5% drawdown that one specific day, total 11.6% drawdown, and that recovery. So Iraq's invasion of Kuwait, you got a really long recovery there, really long recovery after Pearl Harbor, obviously. So those are kind of on the high end. And then you have as little as just very quick recoveries with some of these other things that have happened. It does show overall there aren't geopolitical events, especially not on our nation, aren't huge. Oftentimes there is, an issue. There is normally that initial reaction in the market because it's an unknown, but it does not normally have a very long effect on our markets. Now, what is the market looking at right now when it's trying to assess what's happening with the Israel-Hamas war? So one biggest thing is, will the conflict be contained to Israel and Gaza, or will it spread into oil-producing regions of the Middle East, which will obviously impact oil prices even more largely, and that will have a larger effect on our economy. So that's something we're waiting to be seen. Will it spread to larger countries and otherwise impact the global economy? Obviously, that's another big one. If Iran and Russia and other countries do start to get involved, as they have maybe hinted at a possibility of, then that's going to affect this chart. That's going to affect the amount of time to recovery because it will affect the economy, the global economy as a whole. And the other thing the market is watching and trying to assess is, will the war's impact on the economy increase the likelihood of the Fed pausing their interest rate hiking cycle? If this further escalates, if it does get into more oil producing regions and we see oil prices spike even higher, that's going to affect obviously inflation again. But what will the Fed do? More than likely, and what the market is trying to assess right now is that they would assume the Fed would pause rate hiking cycle in that scenario, just to not to add further stress to our economy, as this war might possibly add stress to the economy. So it really does depend on the longevity and just if this is contained or if it spreads. Issues in the Middle East are uncommon. They have happened many of other times, and so it does not impact us too much until it starts to impact oil or other larger countries, and therefore even possibly getting us involved as well, the U.S. involved more as well. So that is those political events there. I'm going to go ahead and hide myself so we can see a little further here. The next we're getting into is inflation. Again, we're still talking about inflation. It'd be nice to be done talking about inflation for a little while, but here we are, still talking about inflation. I don't know if I can move this. Here we go. Let's get this down here and out of the way. Again, if you're on that podcast, pull up this chart so you can see the numbers that I am talking through. It might make a little more sense than just listening. But this is September's CPI report as of September 2023. And the big news is inflation does seem to be losing its stickiness and its stubbornness. So that is good news. Annual headline inflation was 3.7%. Unchanged from August, as firms were still able to pass along higher wholesale prices. Core inflation decelerated to 4.1% in September, slightly below the previous month's rate of 4.3%. The biggest thing here, and what we're looking at in this chart, is core CPI excluding housing. So you see a pretty big drop if you just take out housing out of that core CPI number. Shelter was the largest contributor to the monthly increase in consumer inflation, accounting for over half of the increase. But this category should not be as impactful in the coming months as softer rent prices work their way into the official government metrics. So we do know that rent prices are softening, and so that will start to affect those metrics over the next coming months. So that is good news. Cost of medical care services fell to 2.6% from a year ago, indicating that some categories are getting less sticky. And used vehicle prices also fell in September again for the fourth consecutive month, pulling the annual decline down to minus 8%. So the bottom line here with inflation is core inflation minus shelter, less shelter, is not as sticky as it has been the last year or earlier this year. So that is finally some more good news. Market expectations are unchanged for what the Fed will do in the November meeting. And just so you know, the market does not think the Fed will raise rates in November. I do think the Israel-Hamas war doubles down on that. They are not going to raise rates in November. So now all eyes are on that December meeting and if what the Fed will do at the December meeting, which will be carefully watching oil prices for insight on what the Fed might be doing in December. Like I said, if there is a lot going on in this world global economy, that we could see that pause in December as well, as the Fed just kind of waits and sees how some of this stuff plays out. So, and what I have seen recently, just for those that are wondering, okay, this is great, we're seeing lower inflation, we're still talking about interest rate hikes because, again, my base case is that there is one more, but again, that will depend a lot on what's happening with Israel and Hamas. But if that conflict, again, stays contained, my base case is that there, personally, after listening to the research, that there is one more rate hike. I do think December, that could come in December, depending on the war. Now, the earliest that experts think that interest rates might fall or be cut would not be until July of next year. But the Fed has definitely been double down on a couple of their last minutes that they, and when they have been spoken to the public, that they are not sure about that, that they are not giving any timeline to specifically when they will start cutting rates. That is going to depend on the economy, and that some people think that we might stay at an elevated interest rate until closer to the end of next year. So what does this mean for you and your investments with inflation easing and with the Fed getting to the end of their investment or their interest rate hiking cycle? Now, something we talked about last time, and just if you haven't watched or listened to the last the September market update, now go listen to that again. We talked about this last time, but the returns, we talked about the returns after that last interest rate hike. And we talked about cash-like investments decaying after that last interest rate hike. So again, we know the market is forward-facing. We saw earlier in this market update that what it does really quickly after bottoms of bear markets and how it turns around, okay? So if the market is forward-facing, if we think we're getting to the end of that rate hike cycle and we can finally put this interest rate issue behind us, if the Israel war is contained to that region and other larger countries are not involved, then we could see a good turnaround in the market, and maybe we would have that second year, 12-month that second 12-month bull market return of closer to 35%. This market has so much room to run if we start getting some good news. Now, a lot of people don't, there's so much negativity, it's hard to imagine good news coming. But this is my reminder to you to not assess your investments with the what ifs of bad news, but also assess your investments with the what ifs of good news. What if good things start happening and the market turns around? Are you invested to where you want to be for your long-term goals? Because you don't want to miss out on returns when this market turns around. So it is a good time to, again, assess your portfolio, assess your long-term goals, assess your risk tolerance, and see if you are aligned correctly in your investments and positioned well for if the market does either of those things. So that's just my plug there, just to always be thinking long-term. So here just about LPL Financial. That's it for really the information I have for you today. This is just giving you more information about LPL Financial, which is the broker-dealer that I go through. They're the largest independent broker-dealer. They do not have any of their own proprietary products, so I am not... I'm not, told to sell you anything or incentivized to sell you anything specific. I give you the best investments that I could recommend for you specifically as a client. Some SIPC membership insurance information there, and another slide here for further disclosures when it comes to just the information in this presentation. And then just how to contact and get a hold of me. Lots of ways: email, phone, website, Instagram, Facebook, YouTube, and obviously the Confident Dollar podcast and staying educated there as well, which this will be uploaded to as a podcast. And thank you so much for tuning in. Hopefully this was helpful. If you've listened to this presentation and you have further questions, please don't hesitate to email or text me with those questions. I'm happy to get those answered for you. Or if you have specific topics you'd like to see covered, let me know those as well, and we can get to those in future presentations. So hope you all have a great day, and just continue to have a great week, and we will talk soon. All right, bye-bye. Lauren Gage is a registered representative with and securities offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including loss of principal.